All right, welcome everybody. We got Levi and Roxana here. We're going to be discussing our 292 unit apartment complex that we're under contract to purchase in San Marcos, Texas. The property name is the 1856, and we're just going to dive right into the deal.
So yeah, we've got a really cool story of how this whole deal came about and our partners on it and Roxana, and we're really excited for it. But we'll leave the details on a later slide of kind of how the deal came about and the returns and everything involved with it. But yeah, 292 units, Class B, built in 1981, value add.
And for those of you who don't know, you probably know Levi or I separately. We've come together and built Cowboy Capital. So this will be our third acquisition under Cowboy Capital, which is really exciting. So to get started, we'll give you a quick background on the team. Myself, Joe Rinderknecht, based out of Idaho, grew up farming and ranching, also have a pretty good background in construction and property management. Got started in multifamily about a decade ago and have done a lot in property management, dealing with Section 42, LIHTC properties. Also worked with a bunch of operators around the country is really how I got my start on the whole full scale of buying a property. And to date, from when we got started, we've got about 600 units, that passive investor as well as active with Levi. I've got this, like I said, that'll be the third property that we have purchased together. And we really, like with Cowboy Capital, we have a large emphasis on what we learned as kids, working the land, working the cows, and that is your word is your bond, and you have integrity and you work hard. And if you talk to any of our investors who've worked with us in the past, they'll tell you that we're not afraid to get our hands dirty and get on site and swing the hammer if needs be.
As Joe mentioned, we both grew up kind of farming, ranching backgrounds, and kind of what Cowboy Capital has been built on is just all the values that we grew up and were integrated into us throughout our childhood and growing up, working hard. Your reputation is everything, and we highly value our investor relationships, and that's why we've transitioned to doing a little bit fewer investors per transaction at a little bit higher investment amount, just because we want it to feel more intimate and more of a partnership like. And I mean, our investors mean everything to us on this. It's not possible without them. Similar to Joe, about a decade ago, I got into rental real estate, bought some duplexes, just really fell in love with the business. Sold off I think I had 60 head of cows, had 60 acres of farmland that I sold off. But I think I got it to 18 units of my own money, and those projects went really well. Started learning about syndication, partnership. I usually introduce myself as more of a deal and finance guy, and those are the things I like. Working with brokers, doing underwriting, the deals, that sort of thing. And Joe and I have just been a great partnership because our skill sets are complementary, our personalities are complementary, and we've just already had a lot of success with our past couple transactions that we've done together.
And we want to keep introducing you to the rest of our general partnership team. We have a third on here that we'll speak about, but he asked us to keep him off of the deck for right now. Both of these gentlemen have been mentors and long-term relationships with. Andy Stroman is somebody I knew even before I knew what real estate was. He had a company in Logan, Utah called, I forget what it's called, but it's an outdoor brand. Most people in Logan, Utah are very familiar with it. He's built his success on buying and selling e-commerce companies. And he also has done real estate for, a decade, two decades as well, and has been somebody I've really looked up to. And there's something to say about being pleasantly persistent. I've been working to get Andy to do a deal with me since I started, and first deal he'll do with me is really cool because it's the biggest one. And he's got a very good work ethic, and he's very tech savvy, and so he'll be a very good addition to the team, bring some investors, and has a lot of experience. Now, Bryant was on a deal with me. He was an LP on a deal in Utah that went sideways. He and I were able to pretty much bring it back to life, and we're able to exit that deal and giving all of our investors a 100% return of their capital, which last year it was hard to do. Since then, Bryant has invested, 7 figures with us on our last couple deals. He's on our board of directors and is now a general partnership with us on this deal. And Bryant's background is in banking. He has done a lot of M&A and just started a bank, as you can read here.
Yep. Well, a little bit later on, we'll give an introduction of the third general partner and just kind of how the whole deal came about. But yeah, here's a couple projects we've done. Joe kind of already talked about our whole portfolio, what we've done. Combined, it's about 1,300 units, where we're, either the lead GP or a smaller GP, and Joe's done a lot of like fund of fund manager deals. So I don't think this is including like passive. I think you mentioned like as passive investors. That doesn't include like passive deals. So yeah, we feel like we have a lot of experience and we're well qualified for this type of asset based on some of the deals that we've done in the past. So if you go to the next slide, a couple properties that we've had exits on, successful exits, but yeah, some that we own today. And then if we go to here's a recent one that we did, the North Russell apartments that Joe and I bought last year. We bought it for 6.8. We're all into it about 7.5. It's currently on the market for 11.8. We just put it on the market a couple days ago, but it's going to be a big success. But yeah, this is kind of a classic example of what our bread and butter is and what we like to do, buying from really long-term owners. We bought this property from the original builder of 98. So yeah, as we get into 1856, you'll see that the seller bought it from a 20-year owner. And that's why there's a lot of long-term tenants, really low rents. And he just got in a bad situation company-wide where he had to fire sell it, where he bought it at a great basis. And now he's selling it at even like 80% of his cost basis to us. So I guess before we jump into the deal and how it came about, yeah, we'll give it over to Roxana now. You can introduce yourself.
Yes, thanks so much, guys. We're really excited to be part of this opportunity. I'm Roxana Atulfan. I am the founder and broker of Clear Integrity Group. We're currently licensed in 5 states, Texas being one of them. We're headquartered in San Antonio, Texas, which is about an hour from the property. Driving in Texas is not very far. Driving to the 1856 is like going to the grocery store for us. So very, very, very close to our home base. I have personally been in the business for 25 years as an operator. Started as a leasing agent and kind of worked my way up. About 10 years ago, I started our own company. I'd like to think that one of the things that we are bringing to any property operations is the fact that we are also brokers. So from day one, as we touch a property, we do due diligence for the property and really look at each deal from the perspective of a future sale. So we work with the owners very closely to make decisions that make the most sense from both a cash flow and a sales perspective. We currently have 30 properties. Out of those, 22 properties are commercial. The other 8 are multifamily. The reason we maintain a small rolling portfolio is what we call it, of multifamilies, because most of our properties we take over and we turn around non-performing properties. So we do it very simple with a lot of hard work, but just basically getting it back to fundamentals, problem solving, and just working with the owners to make sure that we meet their investment goals. So very excited to be part of 1856. It's a property with great potential and very good location.
Okay, if we want to go to the investment summary real quick, I can give a quick introduction of how the deal came about, and then we could let Roxana kind of give like a status of where things are with the deal. Jacques Grayling, he's a current investor with DJE Texas Management Group. He made a lot of investments with them. He's one of the biggest investors, $4.1 million invested in the project with Devin, the principal of DJE Texas Management Group, who the current seller. Yeah, DJE Texas Management Group is having company-wide issues, and it's not that the assets aren't performing necessarily. There's bigger things going on company-wide where he's kind of walking away from his company and just exiting everything. So like basically his whole portfolio is up for sale right now. And because of Jacques in this deal, and I was a small GP on another asset that is being liquidated right now. Jacques reached out to me based on some comments that I was making regarding that deal. And he said, this is the better deal to try to save and pursue. And after kind of looking into it and figuring out there's not really a clean, safe way to take over the project, buying it outright made the most sense. So because of Jacques kind of bringing this deal to light to us and showing us everything that he knew on it, we were able to work out a purchase sale agreement to purchase it. So yeah, DJE bought it in October of 2023, kind of peak interest rates. I think the 10-year treasury was 5% at that time. Like, he bought it at a great basis from a 20-year owner, low rents, put $1.5 million into it. He's been raising the rents, improving the property. Yeah, as I mentioned, he just kind of fell off. His whole, like, they've dropped the ball completely on operations, and now we're coming in and buying it at $21.5 million, which is just an incredible price.
I think the biggest thing is when we were negotiating the PSA, and hence the reason why Roxanne is here. We tried getting some net rental income or occupancy contingencies. They wouldn't approve any of those. They did allow us to bring a property management company and take over operations, because their property management company in-house was just completely dropping the ball. You know, there was multiple tenants without AC. Curb appeal was really bad, to the point that the city was going to fine them for landscaping. Their occupancy was down to 80% or maybe a little bit lower, because they just didn't have any property level cash flow. And so luckily with Roxana, they agreed to sign a management agreement with Devin, with DJE, and with us. And so the biggest way that we're mitigating a lot of risk is that Roxana and her team are working on our behalf right now, even before we purchase the property, which is amazing. Not many property management companies are willing to do that, because two transitions like that is really challenging, but we're sure grateful that Roxana was able to take that on. So Roxana, if you want to talk about what you and your team have done since you've taken over operations in the last 3 weeks, and then we can go from there.
Yeah, so we've been on the ground 3 weeks, and the guys are right. We don't typically take over properties and do 2 takeovers, but in just a short period of time. But this was definitely a great opportunity where you heard me say, back to basics and fundamentals, and I believe a lot of what this property will need is that. We did hire our own manager, and currently hiring, well, we already started 2 other leasing people while maintaining the maintenance staff, which is great advantage for the property. 2 of them have been there for 10 years and 36 years. So they really know a lot about the property, which gives us some advantage in making sure that we don't overspend, but also that we know just about everything about the property. The initial takeover, even prior to the official takeover date, and Levi and Joe are right, we're working on your behalf, because we really have, other than maybe some bank direction, we really have no, I guess, correspondence or interaction with the current owner. The good thing is that anything that we're doing for you, we're doing for the current owner as well, since we're improving operations. But the very first thing we did is walk all 42 vacant units. That was at that time. And then make an assessment of what can we get done the fastest. The second thing we did is improve the curb appeal. This is right on I-35 going south, and it's just got great traffic. It has the access road. It's close to, your HEB and Amazon distribution center, very close to Texas State. So just a lot of really great traffic, and the property wasn't taking advantage of that. We did take care of landscaping, basically put a bunch of flyers and flags and balloons, and really improve that and stay on top of that. From the takeover till today, and keep in mind that the first week we probably were still trying to get information. We actually had to delay the takeover twice, just because we didn't have enough information to be able to function. But we have had 21 leases. That's an average of 7 leases a week. I'd say the first week it's probably closer to 10 leases a week, but the average is the 7. We've had 8 move-ins and 1 move out, with another 11 pending move-ins here in the next couple of weeks. So we've turned, out of the 42 units, we've turned 13 and 6 are in progress. So we're about 45% through by the end of this week.
At what cost? The unit turn cost average?
Amazingly enough, so far the unit turn cost has been about $2,200 or less. It's been anywhere from $200 to turn a unit, all the way to $2,900. The strategy is we always do that. When we rated the 42 units, we rated them 1 through 5, 1 being the easiest, fastest, cheapest to get ready, 5 being the worst and most expensive. So we're leaving the 5 for the end, but we've already moved from the 1s to the 2s. So with each new set of units we're gonna have, it's gonna be a little more cost. Luckily, we've got support from the lender and funds to be able to do that. So that always helps in a situation like that. So that was our first strategy, was to take care of any emergency work orders. You mentioned them not having AC and having violation from the city, so we took care of landscaping, curb appeal, anything that was immediate, and then focus on leasing. Now our next, and we'll continue to focus on leasing, but our next strategy is, or our next a hot topic is renewals. There are about 88 renewals that are between now and another 120 days. The good thing is we probably have had, without requesting, about 10 residents that have come in and they want to renew. We had just this week made a decision of where we want to renew, and that's going to be somewhere between $50 and $200 a renewal. So you can imagine with 88 renewals that will increase the bottom line quite a bit. We'll have to be strategic in not losing too many people, if we wanted to go 200, but perhaps going anywhere between 6 to 15 month long-term leases. The other thing is we have 38 leases that are coming due just at the end of this month that we're working on. Then we have 7 in August, but 43 in September. So we really need to be strategic for those 43 leases, because it's the leasing season now. It might not be as much, in October. And then the lease renewals are down to 80. Right now, there's about 32 month to month. As long as they're actually paying rent in time and they're paying their, monthly premium, we're going to kind of leave those alone. Once we get through the July renewals, then we'll address that. The other thing we did this week, so we'll be effective on the financials at the end of the week, we increased the market rents to the non-renovated unit, the non-upgraded units, I should say. And that's anywhere between $140 and $200, between the 1, 2 1s and 2 2s. So, we will see how we adjust. And this was after our team shopped 6 different competitors, and we did a lot of market research. We might adjust that. We'll see. We got the 21 leases. We'll see how fast we get the 20 leases, the next 20 leases based on the new rents. But we'll just adjust that strategy to what makes the most sense, so we don't keep the apartments vacant. And take advantage of the summer leasing. The other thing is, our goal would be, by closing, there will be 95% and be done with as many renewals as possible. So I'm sure more things will come up. So far, we've had lots of positive attitude and positive feedback from residents, where they walk in the office and they're like, "Thank God you're here." We've seen some really great emails to our staff from tenants. The other really good thing is, even if we have to get some notices from residents, some of them are paying $580 for a 1-bedroom, where the new market right now is $950. The manager that we hire, she's local. She's been local to San Marcos her entire life. She is very good in going out and doing outreach marketing, which our company is. Right now, our company has about 35% of our move-ins come from outreach marketing. That means that our managers go out on a regular basis, and they make friends, they make community partners, they're involved in community events. So we haven't done that yet. So I think that even if increasing the rents will slow down the traffic, with adding the outreach marketing, that's going to kind of even out, and I think we're going to be okay. I would say the last thing, because we're going through kind of different phases. You can imagine 3 weeks when you're not getting all the information you need, a takeover, that you're kind of discovering. You're a little bit in the discovery mode. So we still have to implement, and we're implementing that next week, a website with the chat box. We do have the website app. It's functioning for both leasing and resident portal. The Google ads are going out next week, and the chat bot, and then the community outreach. So like I said, we've been able to do everything else just by drive-by. If you look at the traffic and the leases, half of that is drive-by, another 25% is resident referrals. So far, so good.
That's amazing. Yeah, we really appreciate what you guys are doing there. It's definitely bringing confidence in our investors, and we're getting more. We sent out an update to all our investors yesterday with some of these updates, and it's bringing a lot of confidence.
Yeah, I just want to say, I mentioned it earlier, like how much we value our investors and stuff, but same thing on the management side, like everything that you guys have done thus far and what you're doing, like we are so beyond grateful for you guys, and it wouldn't be possible without your team and spending the day with you guys there while we did our on-site DD, and you guys were working so hard. And I remember, wanting to quit for lunch, and you guys are just still going. And yeah, no, we're
very focused. We can be very focused. Yeah. I would tell you, we say no to deals. We say no to clients. We get approached all the time. For us, it's a partnership. So you guys have been just as involved as we have, and I think that really does make a difference. You talked about how this property is a deal that can be safe and has really great potential. I really believe that the best that you can get out of the property was when both the operator and ownership work together, right? Because you can come up with better solution, with faster solutions. So you guys have been great support, and that's been very helpful.
Great. Well, yeah, I don't think there's anything else for Roxanne. We can let her jump off, and we can finish everything.
Yeah. Thank you for your time.
You can find me.
What's that?
I said, where you can find me.
Yes, ma'am. Okay.
Thank you, Roxanne.
You're very welcome. I'd be curious to get this a copy of what goes out.
Yeah.
See what you guys come up with.
Yeah.
We'll send it.
All right. Awesome. Thanks, guys.
Thank
Talk to
you
you later. All right. Bye.
Bye.
Bye. So Jacques, one thing I forgot to mention is he's going to be getting back 1.3 to 1.4 million of his original 4.1. And since we built a lot of trust with him, and Roxanne and her team have as well, and he's just built confidence in them managing it and us turning the project around, he's going to reinvest all of his money into the deal with us. So that's great news. And like Joe said, we're starting to fill up, and especially after giving these updates of management and where things are going. But yeah, really high level. We've already talked about a lot of this, but yeah, we're purchasing it. It's actually an 8.3 T12 cap rate, but that's going up as we speak, as Roxana's team is in there and they're pushing rents on renewals, all that. Yeah, 73,000 a unit. We're planning a 5-year hold, planning a refinance in as soon as like a few months after closing on the loan assumption, because we have a relationship with Bancorp. They're not going to charge us any like transfer fee or origination fee. So we're just going to assume the loan with them, and we're going to be able to get future funding dollars, like a line of credit for our renovations. It's going to work out great where we can assume this loan, and we really only need, there's a good chance we could close on agency debt before closing, but it's going to be easier to just assume the non-recourse Bancorp loan. Even though it's at a high rate, we'll be able to refinance out of it quickly as we're stabilizing things. Get into the other slides where it talks about the split and all that, but
yeah, so this part, we've kind of talked a lot about this high level. We'll go into a little bit more, right? Purchasing for 21.5. We're going to be raising 5.7 million, which is unique, right? Most deals, I know when the seller purchased this, he raised a little over $11 million.
11.8 million.
11.8. And his cost basis is like 28. Gives us a really awesome and unique opportunity to get it at a lower basis, and our equity's 5.7. A lot of reason for that, right, is with the assumption of the Bancorp loan at 17.22 million, and then 1.6 million in future funding. So really we're like an 88% loan to cost on that.
Yeah, loan to purchase price. Loan to cost, I think we're 72% loan to cost.
Yeah.
And yeah, it's the same loan amount as we would have got agency, just subtracting the future funding. So yeah, I don't feel like we're like over leveraged, especially where we're on a DSCR. We're like, we're going to be cash flowing even in the high 7.95 rate. So if we go to the next slide, luckily 100% bonus depreciation came back for good. And so, yeah, we're projecting really large year one paper losses, 79 to 98 cents on the dollar. So that's going to be, really advantageous, especially when some people are choosing to not 1031 into the deal, and just because you can lock in your low capital gains tax rates, and then you can offset with the bonus depreciation your higher income bracket rates. And then depreciation recapture is always capped at 25%. So you make a spread there. So all around, yeah, it makes the tax benefits are going to be great for this deal. And then, yeah, I don't know if we want to talk too much about this. We've kind of already talked about, our business plan, our pro forma, but these are kind of, we got 3 different management budgets. They were all pretty close in line to this. Like year 1 drops a little bit in NOI. We're actually probably going to be higher than this with what Roxana is seeing so far. And then I think like the year 3 NOI on the asset living budget was 2.2 million, a little bit higher than this. So we feel like we're being really realistic with our assumptions. We did 0 rent growth for the first 2 years, which, based on all the research we're seeing, it's probably going to be the end of next year that rent growth is going to start coming back. As we'll get into these other slides later, you'll see the population growth, the job growth. Even though they've had a lot of supply, it's all getting absorbed. But yeah, I don't know if we want to spend too much time on
the last thing to show you is just like the rent growth and growth that we're expecting. We have 3 years of 0% rent growth, and then 3% year after that, year 4 and year 5. So again, we do our very best to be very conservative, and we could probably even expect a better than a 6.5 cap exit cap too. But I know that you're all here to see what's in it for me as an investor, and where this is a very unique deal. We really wanted to make sure that investors were getting like a large return for their deals. And so most of our deals we've done pretty unique pref, whether we do a full pref equity raise. So this one is no different in that we're giving our investors a 10% preferred return, and then a split from 60-40 up to 75-25. We got a lot of feedback on the last deal that we bought in Boise, where we raised 2.85 from 6 checks, our average investment being about 460 grand. And like Levi mentioned at the beginning, we really like to work with fewer investors and to give you a better, more intimate experience with us and give you more abilities within the project, essentially. So as you can see here, we have different tranches of 250 to 500 to $1 million and $2 million plus. We are really, emphasizing to bring in these larger checks and building relationships with family offices and fund management groups, and feel that the incentive is very much here. Also, we had a 50-50 hurdle after like 23% IRR, but we recently took that out. So now all investors, pretty much, even if we get to a 30% IRR when we exit, get to keep their portion of that upside.
We feel really good about the returns on this deal. Like Joe mentioned, I mean, like our not our last deal, but the deal before that, we just did a straight preferred equity 12 to 17% return. Most of the checks were in that 12 to 14%. No upside though. This deal, usually when we do like the majority of the upside to the investor, we usually only do like a 6 to 8% preferred return. This deal, we just wanted it to be really investor friendly, get people excited about it. And so, yeah, that's why we went with the high 10% preferred return, and just because the deal actually produces that. Once we execute our refinance, this thing is going to cash flow really well. Like, I can't remember the number off the top of my head on the refi, but let's just take a $20 million new loan amount on the refi into agency debt at about 5. We modeled 5.75, but if we do like a rate buy down, more like 5, that's $1 million in interest expense if we refi into a full term IO loan, or we do, 3 years IO and then it amortizes. I mean, our NOI at 2 million, that's $1 million of cash flow after our refinance. So yeah, this is going to be a great deal where it's got good cash flow, good upside all around, where we just feel really good about the returns. But
one thing I'll mention here, a lot of our investors love the cash flow, and they love cash flow soon or quicker in deals, because there's a lot of people who have got into multifamily deals. If you're watching this, maybe even you've been in this situation where you've been in a multifamily deal where they pause distributions or done capital calls. That's not our MO. We like to produce cash flow as quickly as possible. And to give you an idea, just from looking at Roxana's numbers from the month of June, and the expenses, with the new debt that we'll be taking on, we'll be cash flow positive essentially day one, these year one. And these numbers are based on the T12 that we got from the seller even prior to Roxana taking over. So these numbers will ultimately look a little bit better and have stronger cash flow, especially if we can redo that refi. As you can see, we have it as a year two refi. If we can get it as a 6 to 12 month refinance, these numbers are going to be significantly better. So we're all about mitigating risk and being conservative in our numbers, and that refi in year two and having property manager essentially increase our NOI right now, even before purchasing, are all factors.
Yep. I feel like we're being really conservative on our refi, like getting the NOI to 2 million at a 1.25 DSCR at a 5.5 interest rate. It'll size up agency debt to like 22 to 23 million loan amount. We're only looking to get a 20.7 million loan amount on our refi. So like rates could shoot up more. We'd still be plenty good to get a cash out refi. I just feel like we left a lot of margin of safety on this deal. We're buying it right at a great basis with great cash flow as is. And then, once we do our refi, it's only going to expedite the returns better. But you can go to the next slide. So we probably don't need to talk a lot more about this. We already talked about this. I think our rate is going to be a little cheaper than the 5.75, but that's how we modeled it.
I think the biggest thing to note here is that the cool thing is like we were able to negotiate really, really good terms for us on the Bancorp loan assumption. They have a lot to lose if we don't purchase it, and so they were really willing to work with us on getting the best terms possible.
Yep. So our capital stack. Legal, I think we're probably going to come in lower than that. Title as well might be a little under that. Third parties are going to be under that as well. All we need is an appraisal, is what Bancorp said. I think it's like $8,000 or something. Acquisition fee, we're doing 3%. Working capital, 500,000. We feel like that's a really healthy number since we're actually cash flow positive. We don't really need like interest reserve. It's just extra working capital. Loan guarantee fee, 1%. We feel like that's pretty typical. Interior CapEx, we're probably going to be a little less than that based on what Roxana's saying, how cheaply they're doing the turns, and on also getting the rent increases without really doing a bigger upgrade. Exterior as well. I think we have another slide where we can tell exactly what we're doing with the exterior renovation.
Talked about these fees already. There's a lot of sponsors we're seeing out there. They're doing refi, dispo, construction management fees, but again, we want our investors to benefit the most, so we're kind of taking the minimum that we feel is keep us going. So
in-place rent, average market rent, average renovated rent. We don't need to butcher this too much. We've talked a lot about it already, but Roxana is saying, our average market rent classic, I think, is a little bit higher than that number actually, and then the renovated rent is either in line with that or slightly less. We're discovering that we're getting a good rent premium, not by doing a big renovation. People, as Roxana said, a lot of people are coming into the office wanting to renew their lease and not wanting a renovated unit, just wanting to keep the lowest rent possible. But they also see that the comps are higher.
So again, you can look at this, push pause if you want to look at this more, but we've talked about this as far as the rents with Roxana. These are what the units kind of look like right now. And these are units that the seller has already done. One thing to note is while he owned it between 23 and now, they have renovated 54 units. The plan is to go and renovate 30% more. So that's another 80 some odd units. So at the end of the day, we'll have renovated roughly half of the total complex, which is really good because we like to leave meat on the bone for the next buyer. And then CapEx, there's not a lot of CapEx that needs to be done. A lot of it is more just upgrading and fixing the deferred maintenance items. We need to go in and do a lot of parking lot work, cut out the bad parts, do a mill layover, take the pool and the furniture, keep cleaning up the landscaping. There are 2 pools and 2 pickleball / basketball courts, so or no, they're tennis courts that we're going to repurpose into pickleball courts and make a really nice amenity. There's a lot of fencing around the, the property border that we're going to upgrade, make it look really nice. And so a lot of it is just deferred maintenance that we're going to come in, clean up and fix up.
Yep.
So
and
really,
then siding. We half the property, it's kind of split into two properties, like 120 something units, 130 or 40 something units, 15 buildings. But one of the properties, one side is stucco and it was recently painted and it's working really great. The other half is siding, cement board siding, and about 40% of it had been replaced. We're going to be replacing that other 60%. But yeah, overall, we were pleasantly surprised that there wasn't a ton of cap. Roofs look pretty good, but all the main items look pretty good. We came in a little under budget based on the property condition assessment report. Comparing that to our budget, our CapEx budget, we were a little bit under budget. So that was a pleasant surprise. So yeah, just a little bit about San Marcos. It's in between San Antonio and Austin. It's a, growing market. The Austin the Austin MSA, like Austin, Round Rock and San Marcos, Kyle, Buda, that whole MSA is 2.5 million people. San Marcos is about 40 miles south, or 40 minutes south of Austin. But yeah, great growing market, lots of population growth, as you can see, 58% from 2010 to 2024. So why San Marcos? San Marcos is a great growing market. It's in between San Antonio and Austin. Austin MSA is about 2.5 million people. Round Rock, Austin, San Marcos area, you got Kyle, Buda, those little towns. But yeah, it's just 40 minutes from Austin. It's growing really fast. As you can see, 58% population growth from 2010 to 2024. A lot of employment growth, and then it's got the college there, and it's got the river. It's got a lot of beauty and natural beauty and vibrant culture, and yeah. So overall, we feel really good about the area. There has been quite a bit of supply delivered, but it's all getting absorbed and there's not a lot in the pipeline looking ahead. And especially like our rent level compared to new deliveries is a lot more affordable. So like as you can see from what Roxana is saying, there's a lot of demand for, our more affordable rent level. So yeah, you got, the university right there, really close to our site, 17,000 jobs. And yeah, you've got, Amazon, there's 2 Amazon distribution centers, over 5,000 jobs. You've got, go to the next slide. I think there was a huge retail development that was just built. Can't remember how many jobs that is. But yeah, overall, we feel, really good about the demographics and the economy, really diversified.
One thing I'd like to note that a lot of our investors have asked us is how close is it to Texas State? And what's the amount of students that live at the property? It's like 2.5 miles away. You can get there really, really quickly. But our tenant population of students is really like 10-15%. So it's largely still a market rate property, which, most investors that know this market are like, wow, that's surprising because it's so close. But it's also, like Roxana said, right on I-35, yeah. Right? There's a Chick-fil-A, what was the other one? In-N-Out, like right next door. So it's very walkable.
Yeah, it's got over 100,000 cars a day that are on I-35, and it's literally right on the frontage road. So like, I think our demographic, people realize they can just hop right on I-35 and you can go north or south. North, I think it's north, you got an Amazon distribution center, and south, you've got an Amazon distribution center, you got HEB, you've got a lot of different like logistics and different blue collar jobs. And then, yeah, you can go north and be in Austin in like 40 minutes. So really a great location, great, visibility, traffic.
So essentially that's the deal where we're at right now. Today is July 17th. And that's, we need to change it on here, but our due diligence deadline actually ends, it is right there. I was looking at something else. Our due diligence ends today. And so our first closing date is August 16th or August 22nd. with the ability to extend 30 days. We're pretty confident right now that we'll be able to get it closed, if not by August, for sure by September date. At this time, we have about 2 to 2.7, actually we have like $2.5 million committed. So we have $3 to $3.2 million remaining. If you're interested in investing, we are considering 1031 capital above $1 million, retirement funds, 401k, IRA. If you did not know that you could invest with those funds, let me know. We work with the IRA club to help initiate that. If you're interested, let us know. There'll be a link to the deal portal that you can click on and put a soft commit and ask for the data room. Outside of that, we're really excited about this deal and excited to have you join us. If you have any questions, there's our emails, phone numbers at the bottom. Love to have a conversation. We really have an emphasis on building relationships, really getting to know the investors who invest with us or anybody investing with us. So
yep, really appreciate your time watching this. Would be happy to have you guys partner with us. Don't hesitate to reach out. We have like a handful, 2 or 3 that I can think of at the moment that are debating on doing like $500 million checks. So could fill up pretty quickly. Also could take a little bit longer. So just if you're interested and have any questions, reach out and we can talk through it with you and see if it'd be a good fit for you.